to begin.
Coming to you from the desert, somewhere in Arizona. It's here. It's here. The Impatient Investor with Andrew Lanoie.
It's him. He's alive.
If you're looking for new ways to generate wealth and passive income, you're in the right place.
You want it all, don't you?
You're in the right place. This is the podcast for those wanting to take control and gain freedom through alternative investments. If you're following your mom and dad's investment advice,
honey, I'm home.
Yeah, this isn't the podcast for you. Do you know what time it is?
Why, yes. Yes, I do.
I know what you're thinking.
This is going to be unbelievable.
It's time for The Impatient Investor with Andrew Lanoie. Andrew Lanoie.
I get asked this question all the time. What's the difference between indirect and direct investing? Investing directly or indirectly in an asset class is crucial to maximizing returns while reducing fees and volatility in your portfolio. Direct investing can be done on a variety of different levels. One example, you might directly invest in an asset which may require you to make many and even daily decisions. You may decide to co-invest with a team of experts which allow you to maximize returns while not having to make decisions day in and day out. You can also invest directly through the players on Wall Street, but you'll be exposed to fees, increased expenditures, and then there's the volatility. You may be asking, what does this look like? So let's take real estate as an example. The real estate asset class has been a very appealing alternative investment for many years. Direct real estate investment is one option, but being a landlord isn't an appealing thought to many investors. And the time commitment is a common constraint to investing directly. Who can blame them for not wanting to deal with broken toilets, contractors, renovations, and evicting deadbeat renters? So what are the options for investors interested in real estate who don't want to get their hands dirty? One popular passive investment option are REITs. That's real estate investment trusts. REITs are publicly traded companies that by law must have the bulk of its assets and income connected to a real estate investment and must distribute at least 90% of its taxable income to shareholders annually in the form of dividends. REITs are a popular investment option because they are well known and easily accessible. Additionally, you do not have the headache of a direct real estate investment. REITs are just one example of indirect investing. Directly co-investing in the real estate asset class allows you to typically see a huge contrast in fees, and you can avoid the volatility of Wall Street. Direct co-investing in real estate is growing in popularity. It's commonly referred to as a private real estate investment fund or syndication. Private funds specializing in real estate investing offer either debt, equity, or a hybrid option. These private funds are generally capitalized from pooled funds raised through private placements. Investors in private funds usually receive regular distributions through the operation, lease, or sale of real estate, and potentially a liquidating distribution of profits upon termination of the fund after a fixed term. As with most private equity and debt products, there are endless variations in strategy, leverage, fee structures, and buy-in and buy-out restrictions with private funds. They are also generally only accessible to accredited investors, those that have attained a certain level of assets and income, presumably the ability to handle risk. So why go with a private fund instead of a REIT? With both REITs and private funds, you can get into the real estate market without being a property manager. But with REITs, there are additional drawbacks not normally experienced by private funds. First, volatility. The main drawback of REITs is that they're publicly traded. This means that their values are skewed by market forces external to the real estate market and subject to the volatility of Wall Street. Just like all other public securities, the value of REITs rise and fall based on what's happening in the economy, and their values can be greatly impacted by events that have nothing to do with real estate fundamentals. And with Wall Street breaking all kinds of records, experts are already sounding the alarm on an inevitable correction. According to a recent Bank of America fund manager survey, a record number, or 46% of Wall Street respondents say stocks are overvalued. Unlike REITs, private funds aren't tied to stock market fluctuations. While public real estate products can be lucrative investments, they are highly correlated to the stock market, whereas private funds, which do not correlate, result in higher returns with less volatility than a REIT. REITs grow at slower rates. By regulations, REITs can only reinvest a maximum of 10% of their annual profits back into their core business lines each year. This may cause some of the REITs to grow at a slower pace than comparable private funds. Also, REITs may rely on debt. A higher dividend payout by many REITs may force management to undertake higher leverage levels to expand the real estate holdings. That would result in a higher interest rate going out, reduced earnings to you, the investor. And what about access to management? Investors often align their investment philosophy with that of management who head these companies that they seek to invest in. With most public companies, access to the management team is prohibitive, but with private funds, the team is accessible and available to answer questions about their investment philosophy and mission. Do you think you could call a mutual fund manager and get them on the phone? Probably not. If you want to learn more about how I teach investors to create multiple streams of income, just go to stoptradinghours.com.
This was The Impatient Investor with Andrew Lanoie.
You'd do it again if you thought you could get away with it, wouldn't you?
Visit theimpatientinvestor.com for more episodes, and be sure to share this podcast.
Now, don't tell me you're taking all this seriously.
No, seriously. Go share it and rate it on iTunes today.